hey, if you're looking to get an SBA loan to purchase a business or maybe to expand your existing business by maybe buying some equipment or a new building or just getting some working capital to help you grow your business, one of the most important things you need to know is that your business can cash flow the SBA loan. So the SBA and your lender are going to look to see whether your business can cash flow, and that is measured by your debt service coverage ratio. And so I'm going to tell you a bit more about that and how to calculate that, how to make sure that you meet the SBA requirements for cash flow. And if you don't, what are some tips and tricks and things you can do to help make sure that you meet those requirements. But first of all, just a little bit about me. My name is Adam Huxema. I'm the co-founder of ProjectionHub, and we help entrepreneurs create financial projections for potential investors and lenders. I've been doing this for about a decade. Also, I spent a decade as the executive director of an SBA lender, and so I know a good bit about SBA lending, and now in this video, kind of trying to bring the two together, some information about SBA lending as it also relates to financial projections and forecasting. I'm going to be using our acquisition financial projection template here just to demonstrate some different structures and things that you need to know when applying for an SBA loan. And so we'll link to this spreadsheet template in the description of the video below, so you can go grab that link and follow along that way. Also, while you're down there, if you want to subscribe to our channel, that would be awesome. We are producing more and more content like this to try to help businesses that are either looking to grow or maybe acquire a new business, and using SBA funding to help do that. So I'd love for you to subscribe as well. All right, with that, let's dive into some of the nuances of SBA lending and cash flow requirements. Okay, so we are on our at a glance tab of our acquisition template. And I've already got this whole thing kind of filled out with some base information. And we'll put a link to the purchase page to be able to buy this template in the description of the video below. And on that page, you'll be able to watch a video about how to fill this entire template out. I'm not going to walk through that right now. What I'm going to do is really focus more on, once you've got the thing filled out, what are some of the things you need to look at to make sure it cash flows. So I mentioned debt service coverage ratio. This is what your lender and the SBA are going to be using to determine whether your loan application cash flows. And that you can see that here, right up here, this debt service coverage ratio calculation. And that calculation is net operating income, which we have calculated right over here, divided by your debt service, which is your principal payments on your loan and your interest payments on your loans. So the kind of magic number there that you need your debt service coverage ratio to hit is 1.25. You'll want to have basically $1.25 of net operating income for every dollar worth of debt service that you have to pay. So this is what your lender is going to be taking a look at. And the first thing they're going to do is they're going to look historically. And they're going to say, okay, we're going to give you this loan for $1 million. And historically, if we look at our historical financials, did you have enough net operating income to be able to cash flow, to have a debt service coverage ratio of 1.25 or better? And a lot of times, your historical financials, maybe you don't. And this is especially common if what you're going to use the loan for is in some way to expand the business. Maybe it's a piece of equipment that is going to allow you to double your revenue and thereby your net operating income. But it cost you $1 million to get the piece of equipment. Well, of course, you probably wouldn't cash flow this based on last year's financials, right? Because you didn't have the equipment yet. So what you're going to need to do is be able to show through a set of projections that, hey, once we have this equipment, it's going to help us increase our net operating income, and we will be able to cash flow this loan. So that's kind of the exercise you're trying to go through to show, and really that your lender is also going to need to show to the SBA that, yeah, they can cash flow the loan. So 1.25 is kind of that magic number. And based on the numbers that I have entered in here right now, we can see in 2024, based on this example, we dropped down to 1.15. Okay, so I'm gonna show you what are some things we can do about that. So I'm going to go back to our input assumptions. And this example is of acquiring a business. And we are looking to acquire this business for $1.1 million. That's the purchase price. And what we were hoping to do was to borrow $1 million from an SBA loan and $50,000 from a seller note and $100,000 of personal investment put into the business. So that was the assumption that we started out with. But since it doesn't cash flow, we need to make some changes. So here's some things that we could change. We could increase the seller's note. So let's say we want to keep the price the same, but since it doesn't cash flow, we could decrease the SBA loan. Let's decrease our SBA loan to $900,000. And we'll increase the seller note to $150,000. And then if we come back to our at a glance tab, we can see that, hey, look, now we are at debt service coverage ratio of 1.28. So why did that go up? Even though the purchase price is the same, why did our debt service coverage ratio increase? Well, it's because the seller's note here we are assuming is on full standby. And this is common for an acquisition where a seller's note isn't allowed to be paid on until the SBA loan is completely paid off. That's what it means to be on full standby. And so you can see here in this example, we are saying the first scheduled payment is July 1st, 2033. So 10 years after the SBA loan starts to be repaid. And the SBA loan is going to be repaid in 10 years. So after those 120 months, then we start paying the seller's note. So that's an option to improve your debt service coverage ratio, is to decrease the loan amount from the SBA that you're paying right now. Another option, if we go back to our original setup, could be to lengthen the term. So maybe you're able to negotiate a longer term, or maybe some of the SBA loan is going to be used for a building, and the building could be on a longer term. So you might actually break this into two loans. And so you might have SBA building loan, and this could be a 504 loan. This is a common loan product that is used by the SBA for buildings and equipment. And so let's just say we're going to change this breakdown. And we'll say we have a $250,000 loan that's used for the acquisition, and it's going to be paid over 120 months. But there was $750,000 worth of the loan, or worth of the acquisition price, that is actually going to be paid or going to be used for a building, and that can be on a 25-year term. So that's 300 months, and we'll say 8% as well. So now we've taken a portion of that loan and stretched out that term, and we can look back here at our at a glance, and we'll see, yeah, this made a major impact on our debt service coverage ratio. It increased it even in the worst year to 1.59. So the other thing that you might be able to do is if you're looking to acquire a business and you're the buyer, you might be able to say to the seller, hey, look, the business doesn't cash flow at this purchase price. And so we actually need to reduce the purchase price in order to figure out a way for the deal to cash flow for an SBA loan. So that is another option for you to consider as you're kind of negotiating that. You can always invest more. You can raise more investment too, right? So you could reduce what you're borrowing, increase what is being invested into the deal, and that would also improve your debt service coverage ratio. And then I guess the last thing that I would mention is that you could make changes to your projections. So we've got projections here built in for this example acquisition based on these historical financials, and then what we're projecting we could do into the future. And so you could maybe increase your revenue projections or decrease your expenses to increase your net operating income. If you do that, that will also improve your debt service coverage ratio. Now, you're going to have to really make a good case for why your projection should be better than the historical financial results. And so that's going to be a thing that you're going to have to prove to your lender why that's going to be the case. So again, a good example would be, well, we're going to add this new piece of equipment that's going to allow us to double our capacity, double our revenue, double our net operating income ultimately. And that may be the answer, or maybe you just brought on a large new contract and you have the contract in hand and you say, this is going to double our revenue next year. Those are the types of things that the lender might be able to take and say, okay, you have proof here that yes, you can actually improve your debt service coverage ratio that way. So anyway, I'm going to stop with all the different possibilities here, but I hope this has been helpful. If you have questions about cash flow requirements for your particular deal or how to fill this template out to kind of be able to get a baseline debt service coverage ratio in the first place, please reach out to us at support@projectionhub.com or leave us a comment in the comment section of the video below, and we'd be happy to try to help. All right, thanks.